The best MACD, stochastic and RSI trading strategy nobody told you about. In this video I will teach you a clear and precise step-by-step on how to trade successfully in Forex, stocks and commodities or any financial market, and make consistent profits with absolutely minimal risk of stop losses. So, by the end of this video, you'll know exactly when to enter high probability trades with very low stop loss risk using the perfect settings and combination of the MACD, stochastic, and RSI indicators. As usual, we'll have plenty of practical examples. The idea is to fully understand this wonderful trading strategy and to make the most out of it. Here are the 3 essential indicators you need to master if you want to succeed in the Forex and stock markets. In this video, I'll show you how to perfectly combine these 3 powerful tools so you can rely on them in any market condition. When technical analysts discuss the most compatible and user-friendly indicators, the first ones that come to mind are the Moving Average Convergence Divergence, or MACD, Stochastic Oscillator, and Relative Strength Index, or RSI. This combination works so well because the stochastic and RSI indicators compare a market's closing price to its price range over a specific period, while the MACD represents the interaction between 2 moving averages. When used together effectively, this powerful mix can be incredibly useful in the right time frame. First, I will show you the best settings for the Stochastic Oscillator. This is the most popular setting used by professional and institutional traders because it provides highly accurate signals. So, let's get started. Let's talk about the Stochastic Oscillator indicator. This is a favorite tool among pro traders and institutional investors for spotting overbought and oversold conditions. Because many big players use this indicator with the same settings, the signals it generates tend to be quite reliable. So, when you use the Stochastic Oscillator with these settings, you're tapping into a method that many successful traders trust. A stochastic oscillator is a momentum indicator that compares a security's closing price to its price range over a set period. Similar to the MACD, the stochastic oscillator features both a fast-moving and a slow-moving metric. The main concept behind this indicator is to pinpoint overbought and oversold market conditions. You might have already come across this idea in trading books or seminars. But to recap, the stochastic oscillator is a well-known tool for identifying when a market is overbought or oversold. So, here's how it works. First, overbought condition. When the stochastic oscillator reading is above 80, it signals that the asset might be overbought. This typically suggests that the price has risen too quickly and may soon experience a pullback or correction. Second, oversold condition. Conversely, when the reading falls below 20, it indicates that the asset might be oversold. This often means the price has dropped too quickly and might be due for a rebound or upward correction. In essence, these thresholds help traders gauge potential reversal points by showing when an asset might be priced too high or too low compared to its recent price history. While you can use the stochastic tool just by buying in oversold regions and selling in overbought ones, this approach alone might not always yield high success rates. Now that you know the most popular way to use the stochastic oscillator, there's one more important thing to learn. The best and most commonly used setting by pro traders and major investors. That's the 14-period stochastic oscillator. Yes, you heard it right. This 14-period setting is a key strength of the indicator and is crucial for accurate trading. This is the most popular choice among professional and institutional traders because it delivers reliable signals. In our triple threat trading strategy, we'll set the stochastic oscillator to a 14-period with level 80 for overbought and level 20 for oversold. Now you know the crucial secret of the stochastic oscillator. Next, I'll show you how the RSI indicator enhances our strategy by quickly pinpointing short-term market strength right after the stochastic oscillator exits the overbought and oversold zones. Using the RSI will boost our trading accuracy threefold. And now, let's talk about RSI and trend confirmation. The Relative Strength Index, or RSI, is a key technical indicator used to analyze the strength or weakness of a market based on recent closing prices. It helps identify overbought and oversold conditions, but since we already have the stochastic oscillator for that, we'll use the RSI for confirming trends in our strategy. Here's how it works. We adjust the default RSI setting to an 8-period RSI and pair it with a 14-period moving average. The 8-period RSI is perfect for tracking short-term price movements accurately. Based on my experience, an 8-period RSI provides the best statistical range for understanding short-term market trends. The 14-period moving average tracks the market's short-term movement, which aligns with the stochastic oscillator settings that institutional traders and major investors use. Using the 8-period RSI with the 14-period moving average is simple but highly accurate for early trend detection. If the RSI line is below the 14-period moving average, it generally indicates a short-term bearish trend. Conversely, if the RSI line is above the 14-period moving average, it suggests a short-term bullish trend. So, anything above the black line, or above the 14-period moving average, would be a buy signal because it is an upward trend. On the other hand, anything below the black line shows the price on a downtrend, so you would take a sell position. Remember, there are various ways to use the RSI, but in this triple threat trading strategy, we use it to confirm short-term trade signals when the market moves out of overbought or oversold zones. Once you understand how to read these signals, it's crucial to check that the medium-term trend aligns with your signals. This is why the triple threat trading strategy is so accurate for scalping, intraday trading, swing trading, and long-term investing. Next, I'll show you how the MACD indicator can help with this, ensuring you can rely on it to maximize profitability in any trading strategy. Using MACD to identify medium-term trends. The MACD, or Moving Average Convergence Divergence, is a momentum indicator that helps identify price trends and market direction. It works by subtracting the 26-day moving average from the 12-day moving average. A popular way to use the MACD for medium-term trends is by looking at the histogram. It's simple but highly accurate for determining market trends in both Forex and stocks. If the MACD histogram is above the center line, or zero line, the market is considered bullish in the medium term. Conversely, if the MACD histogram is below the center line, the market is bearish in the medium term. With this understanding, you can see why the triple threat trading strategy is so reliable for accurate trading signals. Next, I'll show you how to combine all three indicators to generate high-accuracy trade signals with minimal stop-loss risk. This will increase your chances of long-term success. Let's start by finding a buy signal with the triple threat trading strategy. How to enter a buy signal. Step 1. Check if the MACD histogram is above the zero line. This shows the market is in a bullish phase, which is our starting point. We need to confirm that the medium-term trend is strong. Once we verify the bullish trend, the buy signals from the Stochastic Oscillator and RSI will have a higher chance of success with minimal stop-loss risk. Step 2. Make sure the Stochastic Oscillator is in the oversold area. If the MACD histogram is above zero but the Stochastic Oscillator is still oversold, it suggests the current price drop is likely temporary, and the market will soon continue its bullish trend. Watch for the Stochastic Oscillator to move out of the oversold zone or cross above the level of 20. Step 3. Wait for the RSI line to cross above the moving average line. This confirms that the recent bullish signal is strong, increasing the likelihood that prices will rise significantly. This is why the triple threat trading strategy is considered highly effective and reliable for a long-term success. Step 4. Finally, place a buy order on the next candle and set your stop loss just below the nearest swing low. As you can see here, after you enter the buy position, the price continues to rise, following the bullish trend indicated by the MACD. This creates a strong trading signal that often delivers significant profits with a small stop loss. Keep in mind, perfect signals don't happen all the time, so check across all time frames and markets. This strategy works well everywhere. To further enhance your understanding, I'll walk you through an example of a bearish trend next. How to enter a sell signal. Step 1. Check if the MACD histogram is below the zero line. This shows the market is in a bearish phase, which is our starting point. We need to confirm that the medium-term trend is strong. Once we verify the bearish trend, the sell signals from the Stochastic Oscillator and RSI will have a higher chance of success with minimal stop-loss risk. Step 2. Check if the Stochastic Oscillator is in the overbought zone. If the MACD histogram is below zero but the Stochastic Oscillator is rising into overbought territory, it suggests that the current price spike is likely temporary, and the market may soon return to its bearish trend. Watch for the Stochastic Oscillator to move out of the overbought zone or drop below the 80 level. Step 3. Wait for the RSI line to cross below the moving average line. This signals that the bearish trend is strong and likely to push prices significantly lower. Step 4. Finally, place a sell order on the next candle and set your stop loss just above the nearest swing high. As you can see here, after opening a sell position, the price dropped steadily, following the bearish trend indicated by the MACD histogram. This demonstrates how the triple threat trading strategy consistently provides accurate trading signals, often delivering significant profits with minimal stop-loss risk. However, these perfect signals don't appear all the time. So, it's important to check across all time frames and markets, as this strategy is reliable in any time frame and market. This is a very powerful and reliable trading strategy. The only reason you might lose in the market is if you don't stick to the trading rules outlined in this strategy. The combination of the RSI stochastic oscillator and MACD indicators is also easy to implement across all trading platforms, as these indicators are commonly available. However, if you want the exact settings used in this video, you can find the details in the description below. Simply upload them to your chart, and the indicators will be automatically plotted for you. There's nothing to worry about. You can get the download link in the description. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or X to show your support. See you next time.